Okay. So today we're looking at taxation, and taxation today we're looking at value added tax, which is shortened as VAT. So VAT is also one of the most important, or it's one of the important topics that's frequently examined, and we have to make sure we pay attention and we make sure we remember in the exams as we write. So let's begin with the scope of VAT. So, value added tax, or VAT for short, is an indirect tax. So, it's a tax which is charged on expenditure for goods or services. All right. It is also charged on taxable goods and services supplied by a registered taxable person in Zambia. So, basically, it's just charged on expenditure. Um, the supplier or the trader, uh, adds VAT to whatever they are selling. Then, as the customer is buying, they are paying VAT. It's collected by the trader, then it's remitted on behalf of ZRA. Then, at the same time, the trader can be able to recover the input VAT. So VAT, or value added tax, is administered by the Domestic Taxes Division of ZRA. Then the other point that you need to note is the source of VAT law is basically the Value Added Tax Act, as well as the statutory instrument. Yeah, so this is just a brief foundation of what VAT is. So value added tax is an indirect tax. It's charged on supplies. Then the customer pays VAT via purchases that they buy. Then it's collected on behalf of ZRA by the trader or supplier. Then it's administered by the Domestic Taxes Division of ZRA. Then the source of the VAT law is Value Added Tax Act, as well as the statutory instruments. So now, VAT is charged on supplies, and supplies are classified into two. There are supplies of goods or services, then two, the supplies of neither goods or services. So supplies of goods or services involve the transfer of ownership of goods, right? Where you sell something, you sell a product, you sell clothes, you sell a car or any other item, applying treatment to another person's goods. So for instance, maybe repair services, uh, supplying any form of power, heating, refrigeration, or ventilation. Maybe this can include an energy corporation which supplies electricity, or maybe a filling station. So these supply of goods. The supply of services are all things done for consideration which are not supply of goods. So maybe this can be advisory services, so advisory services, consultancy services, this can also be included as supply of services. Then the other category is supply of neither goods or services. So these, they fall outside the scope of VAT. So those items which fall outside the scope of VAT are neither goods nor services. So the supplies of neither goods nor services. So again, supplies are classified into two: the supplies of goods or services, then the supplies of neither goods or services. Then supply of goods or services are classified into two: supply of goods as well as supply of services. So now let's look at taxable supplies. So taxable supplies, they are the core of VAT, because VAT is charged on taxable supplies, right? And taxable supplies are classified into two. There are those which are standard rated supplies and those which are zero rated supplies, right? So standard rated supplies can also be classified into two. There are those for which VAT is charged at a rate of 16%. Then there are those which are charged at VAT is charged at a rate of 4/29. So standard rated supplies that are VAT inclusive, the VAT rate is 16%. So those that are VAT exclusive, the rate is 4/29, which is a simplified version of 16/116. Then zero rated supplies, the tax rate is 0%. Then exempt supplies, no VAT is charged. I don't know if you have any questions so far.
No questions.
Okay, so now there are two types of VAT. There's output VAT, then there's also input VAT. So what is output VAT? So output VAT is VAT that is charged on the trader's turnover. So the trader's earnings, the trader's sales, how much the trader makes in relation to revenue and turnover, that's how much tax is charged, which is VAT. So output VAT is charged on income or turnover, the annual income or turnover, right? It is the potential tax that can be paid by a taxable person registered for VAT purposes. So this is the amount of tax that can be paid. It's charged on turnover, right? Then input VAT. So input VAT is charged on purchases as well as expenses. So input VAT can be recoverable, right? So whenever a taxable person who is registered for VAT purposes makes a purchase or incurs expenses, those expenses or purchases, it can be recoverable for VAT purposes, provided they are within the scope of recoverable expenses or purchases, right? Then now, what's the format for computing VAT for exam purposes? So the first thing that you begin with is the VAT on sales, right? The VAT on sales, it goes here, right? Then other VAT on other incomes, you also bring it here. Then you find the total, right? Then you deduct the input VAT, which is recoverable. So there's the VAT on purchases, which is put here. Then the VAT on expenses. Then you find the total. Then when you deduct this from that, then you're going to get the VAT, the VAT payable. All right, the VAT payable. Yeah, the VAT payable. So this is a simple format that you need to use in the exam when you're tackling any question relating to value added tax. All right. So basically, you've got output VAT, input VAT, then you've got VAT on sales, VAT on other incomes, and you deduct the VAT which is recoverable, which is the VAT of purchases, as well as the VAT on expenses. So now let's look at registration for VAT. So there are two types of registration. There's the statutory registration and non-statutory registration. So what is statutory registration? So any entity whose annual turnover exclusive of tax or exclusive of VAT, which exceeds 800,000. So if the annual turnover exceeds 800,000 per annum, or 200,000 in 3 months, they are required by law to register for VAT, right? So any entity which expects annual tax exclusive turnover to exceed 800,000 or 200,000 in 3 months is also obligated to register for VAT purposes, right? So those entities which have an annual tax exclusive. Hello?
Mr. Patrick.
Yes.
It had cut. Hello?
Yes, I can get you.
Yeah, I'm saying it had cut, so I had to join again.
Okay, so where did you cut from?
The VAT payable.
The VAT payable. For the
Yeah,
format?
the last part. No, no, for the format, I think we are done. Where you were just writing. I think if that one is done, then you can go on the next page.
Okay. All right. So I was saying the statutory registration for VAT. So all those entities whose annual tax exclusive turnover exceeds 800,000, right? Or 200,000 within 3 months, they are required by law to register for VAT. Then any entity which expects annual turnover exclusive of tax uh, to be 800,000 or 200,000 in 3 months, they are also required to register for VAT purposes, right? Then an entity becomes registrable for VAT on the following dates. So one, for a new business, it's on the commencement date. So a new business which expects its turnover to exceed 800,000, the entity is registrable for VAT on the commencement date. The date it deems it's going to start operating. Then for a continuing business whose tax exclusive turnover exceeds the threshold, it needs to register for VAT within 1 month of an application being made or from the date the application is received. So within 1 month when they make the application, they need to register for VAT, or from the date the application is received by ZRA. Then two, on the day following the hello.
Hello?
Yes, can you get me?
Yes, I can get you.
I don't know, where did we end?
Mm,
Because I think I
the
left.
second point.
I think I left the meeting.
Yeah, I don't know what happened. Even me, that's why. Okay, it's fine, but we can continue. You can share the screen.
Okay, just a minute.
Yeah. Those are entities that are exceeding over 800,000 annual turnover sales, right?
Yes,
Okay, so it's point number two. That's where we ended.
can you see my screen?
Yes.
Yeah. So I was saying an entity becomes registrable for VAT on the following dates, right? So one, for a new business at the commencement date, if it expects its annual turnover to exceed 800,000. So if it expects its annual turnover to exceed 800,000, and it's a new business, it becomes registrable for VAT on the commencement date. Then for a business which is continuing to trade, like it's been existent for the longest period of time, then it exceeds its annual turnover exceeds the threshold, which is 800,000 per annum or 200,000 in 3 months, or per 3 months 200,000 per quarter. It becomes registrable uh, for VAT purposes within 1 month of an application being made or from the date the application was received. So within that 1 month, when they make an application to be registered for VAT, that entity becomes registrable for VAT purposes, or from the date the application is received by ZRA, right? Then on the day following the period when the limits are exceeded, if the entity does not register within 1 month. So if the entity decides not to register within 1 month, the following day, so if the threshold is reached today, then the following day, that particular entity becomes registrable for VAT purposes. I don't know if you have any questions.
No question, Mr. Patrick.
Okay. So now, then voluntary registration. So voluntary registration is registration for VAT, right? Where a person who supplies, or rather, a person who supplies taxable goods or services and their annual turnover does not exceed the threshold. So for that entity which supplies taxable goods and services, but their annual turnover does not exceed the threshold, which is 800,000 per annum or 200,000 per quarter, right? That particular entity can register voluntarily for VAT purposes. So they're not obligated by law to register, but if they feel they want to register for VAT purposes, but their revenue does not exceed the threshold, they can voluntarily register for VAT purposes. Then advantages of voluntary registration. One, an entity will be able to recover input VAT. So if they register for VAT purposes, they'll be able to recover the input VAT. Then two, it will signify growth prospects because only entities with a turnover of 800,000 or over are required to register for VAT purposes. So if an entity voluntarily registers for VAT purposes, it means their prospects, their chances, or maybe there is belief that that particular entity is going to earn a turnover of 800,000 kwacha or more, because only entities that meet that threshold are those that register for VAT purposes. Then the company will be able to compete with entities which are registered for VAT because its costs will not be distorted by VAT being inclusive. So if VAT is inclusive and that particular entity buys supplies, those supplies are going to be expensive if it is not registered for VAT purposes. But if it's registered, it means it's going to be able to recover the VAT on the purchases, the materials that it uses, or maybe the goods that it buys to supply to the customers. So it will be able to recover that input VAT in that way. Its costs of production or costs of supplying goods or services are going to reduce, and it's going to be able to compete effectively with other companies which are registered for VAT purposes. Then disadvantages, on the other hand, VAT registration results in increased administrative costs. So, right, if you register for VAT, you need to be making returns on a monthly basis, right? A lot of it's monthly, 3 months, or on a quarterly basis, but you have to make sure you're paying VAT. And that act of paying, preparing the returns, calculating the VAT payable, it increases the administrative costs, right? Because you need to employ an accountant who's knowledgeable about that particular information in relation to tax. You know, the act of going to ZiCA and remitting the VAT, that increases the administrative costs. Then non-registered customers will have an increased level of costs. So if a customer is not registered for VAT purposes, they won't be able to recover their input VAT, for which this particular company, which is us, we are charging VAT on our supplies, but the customer is not registered for VAT. It means from that customer's perspective, its costs of supply, its cost of goods are going to be high due to the VAT being inclusive. Then penalties will be charged if an entity which fails to pay for VAT. So penalties are usually charged if an entity fails to pay for VAT. Now, let's look at deregistration. So, an entity can register, but at the same time, it can also deregister for VAT purposes. So, this is a cancellation of VAT registration, right? That's what deregistration simply means in the VAT context. It's the cancellation of VAT registration, and it occurs when the business is closed or ceases to trade permanently. So, the reasons why a company can deregister for VAT purposes is one, if a business is closed or it ceases to trade permanently. That's number one. Then if ZiCA is satisfied that the trader is no longer making taxable supplies, no intending to make taxable supplies. Remember, tax or rather VAT is charged on taxable supplies. Then if that particular supplier decides to stop producing taxable supplies, right, it will no longer be relevant to register for VAT purposes. So it needs to deregister. But for it to deregister, or for the deregistration to be confirmed by ZRA, the institution or the authority, which is ZRA, needs to be satisfied that that particular entity is no longer trading in taxable supplies, or it's no longer intending to trade in taxable supplies. Then, if there is a change in the legal status of the trader, right? So, for instance, a trader shifts from sole proprietorship to company, right? So, the sole proprietorship or the sole trader dies and becomes a company. So, that particular sole trader is deregistered for VAT purposes, and now the new company, the limited company, is what's supposed to be registered for VAT purposes. Then point number four, if the trader applied for registration before commencement and the trader does not commence trading on the expected date. So this particular trader thought or believed or projected that they're going to start trading on the 1st of August. But due to one condition or the other, due to maybe lack of capital, or they don't have the necessary manpower to begin their business, they don't commence on the 1st of August, right? But they already registered for VAT purposes. It means after that, when that date comes and they don't start operating, they can be able to deregister for VAT. And uh, the these are the reasons which may lead to an entity being deregistered for VAT purposes. I don't know if you have any questions so far.
Mm, Mr. Patrick,
Yes.
I wanted to find out on this other one.
Which one?
Like for those, like they are sole trader and they are not registered for VAT.
Mm-hmm.
Then you want to buy some supplies from them, which those supplies you need to claim like some input VAT. What will happen? Like there are those suppliers at town center.
Oh, but they're not registered for VAT.
Yeah. So what happens? Yes, but for example, us we are registered for VAT,
Uh-huh.
and we can claim from the input from the supplies
Yes.
on purchases. Now, let's say those purchases are coming from a company that is not registered for VAT, and the invoice they give, it's the one that does not even show VAT on it.
Okay. But
So in that case, how can it be?
I think it can be difficult to
Uh,
recover. It can be.
Actually,
Hello?
they are they are registered under like 10 of. Okay, okay. I get you.
Oh, I know. I didn't respond. I didn't respond. Eh?
No, you've said that it can be difficult to recover.
Oh, you heard it. Yeah. So I think, yeah. I was
Yeah.
saying it can be difficult to recover because what the the evidence for recovery is an invoice which you have, right? The supply invoice which has got that the tax, the VAT tax, which is inclusive in the supplies that you buy. But if you don't have that receipt, which evidences that these particular goods that you bought, they've got VAT included in them, it can be difficult for you to recover the VAT. Hello?
Okay. Hello, I'm getting you.
You getting me?
I'm getting you, Mr. Patrick. You can continue. Yes, you can continue.
All right. So, accounting for output VAT, right? So, what's output VAT? Or output, we said it's charged on the sales, right? It's a
Mm,
VAT that's charged on the sales. So, output VAT is paid on sales or other incomes gained by the entity. The taxable value of supplies, right? So, whenever you make a sale, that sale, you issue an invoice. That invoice is it needs to be a tax invoice. It needs to have a TPIN as well as uh, the amount of invoice, the amount of tax which is included in that particular sale that you made, right? Then, but there are also some conditions that you need to understand that taxable value of supplies. So where a cash discount is granted, in theory, output VAT is charged on the undiscounted sales price. So if you give a cash discount, the undiscounted cash price is what VAT is charged on. Then where a trade discount is given, output VAT is charged on the discounted price. But this is not really examined as much, it's just for knowledge's sake. But now,
okay.
what is a tax point? Right? A tax point is a time when the supply is deemed to have taken place. Right? So that's a tax point. So a tax point is when the supply is deemed to have taken place. So why is a tax point important? A tax point is important in determining the tax period in which a VAT relating to a supply should be accounted for. So a tax point is a time when the supply is deemed to be taken place, right? So this is just it's a point in time where ZRA considers a sale to be taken place, right? And the importance of a tax point, right? It helps ZRA to determine the tax period. So which is the tax period, right? From which point to which point, right? So it helps in determining the tax period in which the VAT relating to supply should be accounted for. Then two, it helps in deciding the scheme or VAT rate which should apply when there is a change in the VAT scheme or VAT rate, right? So it helps, to determine like the tax period. Over which period are we going to pay tax? Over which period is this company going to charge uh, VAT? Then two, it also helps decide which scheme or VAT rate are we going to charge on this particular supplies where there's a change in VAT or VAT rate, in VAT scheme or VAT rate. So then reclassification of supplies occurs when the supplies are changed from exempt to zero rated. So whenever there's a change, a supply used to be rated at zero, then it changes to exempt, then there's a change in VAT scheme, right? So in that moment, it's also important to know the tax point. Then there's also what is called the basic tax point. So the basic tax point is a time when the supplies are delivered, collected, or made available to the customer, or when the services are performed. So the tax point is when the sale or the supply is deemed to occur, right? So this is where it's deemed. It's not really the actual date, but this is where it is perceived to occur. This is where it is just, it's a notional date where they think the ZRA thinks that the sale occurred, but the basic tax point is the actual date when the supplies are delivered, collected, or made available to the customer when the services are performed. So the basic tax point is amended in the following situation, right? So when the tax invoice is issued or payment is made before the basic tax point. So if the basic tax point say is today, but the invoice was issued say on Wednesday, right? then the basic tax point can be changed to that date of the issue of the invoice or the date when the payment was made, right? That's the basic tax point. And two, where an invoice is issued within a period of 14 days after the basic tax point, right? The tax point is the time when the invoice is issued. So where an invoice is issued within a period of 14 days after the basic tax point, the tax point is the time when the invoice was issued. So this is just some theory that you can memorize. You have seen some questions where they ask about the basic tax point and the tax point, then you just be able to write something so that you gather some marks. I don't know if you have any questions or contributions or experience
No questions, Mr. Patrick.
or experience as we take a commercial break.
Oh, okay. Hello?
Hello, yes, I can get you.
Yes. I'm saying experience is there, but you covered it. I think in the first topic. That's what we do. Like we calculate the tax output,
Yes,
and or we add all tax output from sales, and we before we pay to ZRA,
yes.
we less the tax input from suppliers.
Oh
Yeah,
yeah, yeah.
then the remaining, that's the one that we pay to ZRA. So at times you find that where I was stuck some other time. What do we do in that case?
Oh yeah. Okay, so let's
Yeah,
carry
our
on.
tax payable to ZRA, it's a negative figure.
Oh yeah, so then
Okay.
it means it's recoverable. Then it means if it's negative, then ZRA owes you.
Oh, okay.
Yeah. So let's continue. Hello? Hello?
Hello, I'm getting you. We can continue.
All right. Okay. So now accounting for input VAT. So now, so as I said, input VAT um, is recoverable, right? But how or what are the conditions for the input VAT to be recovered, right? So one, the trader must be registered for VAT purposes when the supply is made. That's the condition number one. Then the supply must be made to a taxable person, right? That's condition number two. Condition number three, the supply must be evidenced with a tax invoice. Then number three, the expenditure must relate to the business activities, production or delivery of goods or services, right? And then a VAT must be recoverable, right? So these are the conditions,
Yes.
and you need to know them and know them very well.
Okay.
So one, the trader must be registered for VAT purposes when the supply is made. And two, the supply must be made to a taxable person. Then three, the supply must be evidenced with a tax invoice. Remember where you asked saying, what if those people in town center, they're not registered for VAT purposes, right? Can you recover the VAT? So here it says for you to recover the
Yeah.
VAT, the supply must be evidenced with a tax invoice. So if there's no tax invoice, it means it cannot be recoverable. Hello?
Hello, I'm getting you.
Yes. So now let's carry on. So now there's what we call bad debt relief. So this is where a company has got a bad debt. They've got receivables, but those receivables, uh, the customer is unable to pay them back, maybe due to bankruptcy or one reason or the other, right? So now, if there's a bad debt, ZRA says uh, the entity can recover, or rather, the entity can have a bad debt relief, right? So, bad debt relief is included as part of the input VAT. So when we're calculating the input VAT, input VAT is recoverable. So now the bad debts, they are included as part of the input VAT, right? Then they are treated as though they are being recovered, but actually they are bad debts. So now, relief is given where a supply has been made in exchange for consideration in in form of money or barter. So where a supply has been made in form of um, consideration, or rather in exchange for consideration in money or barter. So that's the first condition. The supply has been made in exchange for consideration or money or barter, right? Then two, the output VAT has been accounted and paid for by the supplier. So the the output VAT relating to that particular bad debt, it has to make sure it's paid for by the supplier. Then two, whole or part of the bad debts has been written off by the supplier. So that particular supplier that wants to recover must write off that debt. Then at least 8 months must have elapsed since the time when the payment was due. So at least 8 months would have elapsed since that payment was due. Right? So these are the conditions that can lead to um, one recovering bad debt relief. So a trader or a supplier which wants to have bad debt relief, they can recover, or rather they can get that relief if these conditions are met. I don't know if you have any questions so far.
No questions.
Okay. All right. So now there are those expenses which are non-recoverable, right? There are certain expenses which are non-recoverable, right? So some of the examples are one, business entertainment. So when you're given a VAT question, there are certain expenses that you're going to be given, and you should be able to cite out those which are not recoverable for tax purposes, right? Which are not recoverable for VAT purposes. So one of them is business entertainment. So business entertainment includes entertaining employees or entertaining suppliers or entertaining managers, right? So all those expenses relating to entertainment, they are not recoverable for VAT purposes, right? Then motor cars which are not wholly used for business purposes, right? Those are not recoverable expenses. So you buy a car which is not used, which is not wholly used for business purposes. Maybe it's used as a personal to hold a vehicle for a director. It's not, that expenditure is not recoverable for VAT purposes unless it's acquired for resale by a car dealer. So if that particular company that's recovering VAT is a car dealer and it buys a vehicle which is not used for business purposes, it's for the sole purpose of resale, then the VAT can be recovered. Then if the car is also acquired for use in a taxi business or leasing to a taxi business, that particular car can be recovered, or rather, that particular expenditure on the car can be recovered for VAT purposes. Then if the car is acquired for use in a self-drive car hire business or driving school. So if you've got a business for car hire, right? Then you buy a vehicle which is not being used wholly for the business, VAT can be recovered, right? Then expenses incurred on the domestic accommodation for the directors, right? So if directors are given a house that they live in, which is owned by the company, or in other words, the company pays money, spends money on paying rent for directors. Maybe the director stays in Salama Park, or maybe there's this area. What's the name of this area? Foxdale or Kingsland. Because I hear in Kingsland, that's where most of these my directors and all these rich people who are doing well, that's where they stay. You know where Kingsland is?
Yes.
Yeah, where is it exactly?
Mm, along the Leopard Hill Road.
Okay, yeah. So those houses I hear they're expensive, huh?
Yes, it's 1 point. They're actually very expensive. They're the anyway, we'll talk later, but actually, it's expensive. It's for the big guys in Zambia who
So
live there.
yeah. So now, so if a company is spending expenditure on domestic accommodation for directors who are living in Kingsland, it doesn't matter how much, that amount is not recoverable for tax purposes. Then also telephone bills, those are not recoverable. The cost of petrol, unless it is bought for resale. So the cost of petrol is also not recoverable for VAT purposes unless the petrol is bought for resale purposes. Then the cost of diesel. So the amount of money spent on diesel, only 90% of that amount is recoverable for VAT purposes. The rest, the 10% is not recoverable. Then for mining companies, only 70% is recoverable for diesel expenditure for the cost of diesel. Then uh, recovered in full if the diesel was purchased for resale. So if the diesel was purchased for resale, then it can be recovered in full, right? Then domestic refrigeration, air conditioning, mobile phones, motor vehicle parts, television sets, digital satellites, decoders, and all these other items which are used in the office, VAT is not recoverable. So this domestic refrigeration equipment, you buy a fridge, you put in place an air conditioner in the particular office. There are more expenditure on mobile phones. You're buying motor vehicle parts which are designed to change or improve the operational capacity of a car. Then it means it won't be recoverable. Right? Then now there's what we call partial exemption. So what is partial exemption? Right? So partial exemption occurs where a taxable person produces both taxable and exempt supplies. So where you've got this particular where a supplier were producing both taxable supplies and non-taxable, or maybe we're also producing exempt supplies, right? So for exempt supplies, the tax rate is 0%. But for taxable supplies, the VAT rate is 16 or 4 over 29, right? But they're bundled together, they're produced together, they're not segregated, they're not classified, but they're all produced together. So if you've got maybe 1 million worth of supplies of sales, right? But they include exempt as well as taxable sales. Then it means you need to find the proportion of taxable supplies out of the total supplies. How do you do that? You need to divide the taxable supplies over the total number of supplies. Then that percentage that you find is the amount or is the proportion which is recoverable. So all those expenditures which are related to the production of those goods, then they are recoverable, consistent with the proportion of the taxable supplies. So for now, this doesn't make sense, but if you practice and you go through a question, you'll be able to answer properly or answer questions. Do you have any questions so far?
No questions, Mr. Patrick.
All right. So now there's also what we call a cash generation, or rather a cash accounting scheme. So what is a cash accounting scheme? So in a cash accounting scheme, a trader rather accounts for VAT on basis of receipts and payments. So whenever the trader receives money or pays cash, that's when they need to register, or rather they need to pay the VAT. So the tax point is when the payment is made or the cash is received. So remember, a tax point is when tax is deemed to be, rather, this is when the sale is deemed to be made, right? So that's the tax point. So a tax point is when the cash is received or when the payment is made. So the cash accounting scheme, where VAT is charged on the basis of receipts and payments, is available only to members of the Association of the Building and Civil Engineering Contractors, ABCEC. Then also VAT registered supplier in the electricity generation subsector. So all those companies which own maybe a hydroelectric power plant, which is supplying electricity to ZESCO, these they can use the cash accounting scheme where VAT is charged on receipts and payment basis, right? So now, what are the advantages and disadvantages of the cash accounting scheme? Right. So one, VAT is only payable. These are the advantages, right? VAT is only payable if the customer have made the payment. So if the customer has made the payment to us, we are registered under the cash accounting scheme. It means we can be able to recover the VAT immediately or when the cash payment is made. Then two, it is easy to prepare a VAT return because the cash book can be used to do so, right? Then three, bad debt relief occurs automatically because no VAT is accounted for when the customer do not make a payment. So there's no such thing, you don't need to calculate the bad debts and include it in the VAT recoverable. But if the customer can't pay the money, it means it won't be included for VAT purposes. Why? Because the VAT is paid when the cash is received. So if the cash is not received, it means the VAT will not be paid. Then disadvantages. Input VAT is only reclaimed when payment is made. This will mean that claiming input VAT will be delayed if the payment from the customer is delayed. Again, so input VAT is recovered on a cash basis. And if the cash is not received on time, then it means recovering input VAT is going to be delayed. Then two, the scheme is not open to all kinds of traders. Only members of the Association of Building and Engineering Contractors, ABCEC, are the only ones who can recover the VAT. The rest of the people, or the rest of the traders, are unable to register for the cash accounting scheme. Then now, let's look at the due dates and penalties. Right? So VAT must be paid on the 18th day after the end of the tax period. Then the penalties and interest for late submission are two. There's one, daily penalty, is the higher of 1,000 penalty units, which is 300 kwacha, or 0.5% of the amount of the VAT payable, right? So whichever is higher between the two, 100 penalty units, which is 300 kwacha, or 0.5% of the VAT, which is overdue, right? So whichever is higher between the two is the one that's going to be treated as a penalty. Then two, interest on the Bank of Zambia discount rate plus 2%. So you get the interest, the Bank of Zambia interest rate plus 2% per annum, and then you you multiply it by the amount of VAT which is payable, or rather which is overdue. So this is also important because sometimes you can be asked to or rather to calculate the penalties which are going to result in late payment of um, these this tax, which is VAT. All right. So now let's look at reverse tax or reverse VAT. Right? Hello?
Hello, I'm getting you.
All right.
Hello? Yeah.
Yeah, I can get you.
Okay.
Yeah.
We can proceed.
Okay. All right. So reverse tax or reverse VAT. So uh, this is VAT which is paid by a party receiving services rendered by a non-resident supplier where a tax agent has not been appointed. So reverse tax, this is where a company is receiving services by a non-resident company. So for instance, the way your company is a subsidiary of a Chinese company. So that parent company, when it offers advisory services or management services to the subsidiary, where a tax agent has not been contracted, then it means it's going to pay reverse tax, right? So now, services are considered to be imported if they are rendered in Zambia or they're utilized anywhere in Zambia, regardless of where it is performed. So maybe the services they're performed in China, but they're utilized here in Zambia, then you can say those services are imported. So examples of these services include management or other consulting services, or management or other consultancy services, then also technical advisory services, then marketing information, as well as sales promotion. So, right. How do we account for reverse taxation? So the receiver of the services prepares a tax invoice equivalent to the value of services received, and 16% output VAT is charged on that amount. So the company receives services, right? The value of those services, maybe the services are costing 1 million kwacha. We receive the services, but we treat those services we receive, the value of 1 million kwacha, which we paid to the entity that was giving us those consultancy services, for example, So the value, which is 1 million, we treat it as though it's a sale that we're making, as though are the ones who are rendering those consultancy services. Then we issue an invoice, which includes a 16% output tax. Then the tax point is the area of the time when the payment is made, the time when we make that particular payment to that particular entity, which is rendering those services. Then the time when the invoice is received from the supplier. Then the time when the services are actually rendered or performed, right? So reverse VAT can be avoided if a non-resident supplier contracts a tax agent to invoice the resident client on his behalf. So now, the tax point, as I said, is the area of the time when the payment is made, when we make the payment. Then two, the time when the invoice is received from the supplier. Then three, the time when the services are actually rendered or performed. So this is the tax point. But now, how can we eliminate reverse tax? If that particular entity, the mother, the parent, the mother company in China contracts a tax agent here in Zambia to issue an invoice equivalent to the services that it is rendering to the subsidiary here in Zambia. In that way, the reverse VAT will not be applicable. So now, how does a company appoint a tax agent? So one, a non-resident supplier can appoint a tax agent, which is an entity which is registered for VAT purposes here in Zambia. And this particular entity is supposed to issue invoice or invoices on behalf of that particular non-resident entity, right? So the agent must register a tax agency, right, with the words tax agent included in its name. The tax agent invoices will be used with the principal's name in the brackets. So, for example, the subsidiary here in Zambia, or maybe the tax agent here in Zambia, is banded tax agents as required by ZRA. Then the entity whom, or the company, the entity which this tax agent is performing the services for, supposed to be in the brackets, like for DT Co consultants. All right. So this is just some theory and some notes that you need to know in case you're asked about reverse taxation. So now, what are the obligations? What are the obligations of a tax agent? So one, the tax agent needs to notify the Commissioner General of intentions to take a new principal or intentions to terminate a contract with an existing one. So this tax agent needs to notify the Commissioner General, which is basically ZRA, in case it doesn't want to continue the relationship with the current principal, or it intends to terminate the contract in future. Then the tax agent also is obligated to keep and preserve and produce any records of accounts relating to each principal. So the company can have multiple principals, but it needs to keep and preserve and produce any records which are required. Then it needs to submit a tax return. Then it needs to pay any tax under the act which is required. Then it needs to comply with the requirements of the Commissioner General in respect to the business that it undertakes. So these are the obligations of a tax agent. With that said, our lesson has come to an end. Hello?
Hello?
Yes. So with that said, the lesson has come to an end.
Okay, so we are done with VAT.
Yes, we're done with
Or
VAT.
So we are remaining with what other topics?
So for
In
now,
tax.